Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at UiPath.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. I think the most important thing for you to understand right up front is that UiPath, it's just not the same company it was, say, 2 years ago.
Right.
We're seeing this fundamental shift, a really positive pivot away from that old growth at all costs mindset.
Towards what's the new model?
It's what we're calling profitable growth inflection.
Inflection. Okay, that's a key word. It sounds like a turning point. So it's not just that they're growing, but the growth itself is, changing, becoming more efficient?
That's exactly. It's becoming efficient, and it's starting to generate real, actual cash. The model is finally hitting its stride.
But what's driving that?
It's the business model itself. It's built on subscriptions, on recurring revenue. And with a model like that, once you pull back a little on the crazy spending to get new customers,
The profits just start to flow through.
the operational leverage, it kicks in massively. It's really setting them up for, I think, some sustained, high-quality expansion.
Okay, so let's get into the numbers that prove this out. Where are you seeing the clearest evidence of this inflection point?
It has to start with subscription revenue. I mean, that's their lifeblood. It's their highest margin segment.
Right.
And if you look at the financials for the first 9 months of this fiscal year, subscription revenue hit $63.9 billion.
$63.9 billion. And just to give you some context on that, last year in the same period, it was $42.1 billion.
Right.
So that's a 52% year-over-year increase?
52%? Yeah.
That's not a small jump. That's real acceleration.
Yeah.
It feels like enterprises aren't just testing the waters anymore. They're fully committed.
They are all in. That kind of growth velocity, it confirms that the demand is robust, and more importantly, it's sticky. But, strong revenue is only half of it.
You need the profitability.
You need the profitability, and that's where that operational leverage really starts to shine.
Okay, operational leverage, that's the magic term for investors, right?
Right.
That means every new dollar of revenue costs less to earn. So what are the margins telling us?
They're telling us that UiPath is playing in the big leagues now, the elite tier of software. Their gross margin expanded to 82% over those 9 months.
82%. Wow. That is, for you listening, that is a massive number for any software company.
It's huge. And it was 79% last year.
So it's not just high, it's improving as they get bigger.
Exactly. And that margin expansion is so critical. It proves that the cost of delivering the service is growing much, much slower than the revenue coming in. If you can keep a margin in the 80s, you have a fortress, a truly scalable SaaS business.
And I assume that efficiency is trickling down. Like, are they getting better at actually selling the product too?
They are. You can see it in the sales and marketing spend. As a percentage of revenue, it's actually dropped, down to 18% from 19%.
So they're spending less to make more.
They're acquiring customers more efficiently. It suggests the platform is kind of selling itself, or at least existing customers are expanding their usage, which is always much cheaper.
And this all leads to, I think, the most crucial metric for a story like this. Cash flow. Is the business actually making money?
This is where it gets really interesting. The business has turned decisively cash flow positive. Net cash from operations hit $174.5 million in those 3 quarters.
$174 million. And that's up, 14% year over year. So for you, the listener, this means the company is funding its own growth now.
It's self-sustaining.
They don't need to borrow money or issue new stock to pay for R&D or sales.
Exactly. And that self-sustaining power is the foundation for everything else. Speaking of which, their balance sheet, it's a fortress.
A fortress. Okay, tell me about that. What are we talking about? Cash on hand.
A huge cash cushion. Minimal debt. Get this. Over that same period, they recorded $37.3 million just in interest income.
Just from the interest on their cash.
Yep. They're basically earning millions from their savings account. It's a huge sign of financial strength.
And there was something else in the financials about taxes. They had a tax benefit.
Good catch. Yes, a $7.2 million tax benefit compared to having to pay tax the year before.
Why does that matter?
It's a sign of a maturing financial operation. It means they're getting smarter about their international structure, R&D credits, things like that. It basically boosts their future profit potential without selling a single extra product.
So strong growth, fantastic margins, a pile of cash. This leads me to the big question. The competition. You have giants like Microsoft and Salesforce adding automation tools everywhere. Why would a big company stick with UiPath?
That brings us to their moat, their competitive advantage, and the primary one is just incredibly high switching costs.
Okay, unpack that. Why is it so hard to switch?
Because when a company adopts UiPath, they aren't just, installing one app. They are embedding thousands of little software robots deep into their core processes.
Ah, so it's not on the surface. It's in the plumbing.
It's the plumbing, exactly. It's connected to their HR systems, their supply chain, their financials. To rip that all out and replace it, I mean, you're talking about a massive, costly project that risks breaking your entire business.
It's like a tattoo on their operations.
It really is. The risk is just prohibitive for most companies. That's a huge advantage. Plus, they were here first. They have the brand, the first mover advantage, and they're using that head start to build out their AI capabilities now.
So if the business is this strong and the moat is this deep, management must think this stock is cheap, right?
They're screaming it from the rooftops.
How so?
With an aggressive share repurchase program, this is them putting their money where their mouth is.
Okay, give me the specifics.
Between August and October this year, they bought back nearly 14,000 shares. The average price was around $12.15.
$12?
But here's the kicker. They still have about $516.7 million authorized for more buybacks.
$500 million. Okay, so for you listening, that does two things. It signals that management sees value, and it creates a sort of natural floor under the stock price, right around that, say, $11 to $13 zone.
It suggests a major disconnect between the share price and the real value being created by those 82% margins.
All right, let's flip the coin. We have to talk about the risks. What's the biggest thing that could go wrong here?
The biggest headwind is definitely the macro environment. The fear is that if we hit a bad recession, companies will just freeze all their IT spending.
And that would slow down UiPath's growth.
It would. But here's the counter-argument.
Mitigation.
The mitigation is that UiPath sells cost savings. Its whole purpose is ROI. So when budgets get tight, the tools that actually save you money are usually the last things to get cut. Plus, that fortress balance sheet gives them plenty of runway to wait out a storm.
Okay, what about the other big risk? The one we touched on. Competition from the giants. Microsoft packaging free RPA tools into their software. Doesn't that just commoditize the whole space?
It's a real threat, for sure. You can't ignore it. But Microsoft can offer the simple stuff, the basic automation. What they struggle to replicate is the depth.
The complex, mission-critical stuff.
Exactly. The really deep integrations that UiPath has spent years building. And again, you run into those switching costs. A free tool is great for a simple task, but it's not going to replace the thousands of robots already running the core of a global enterprise.
So the moats hold up for now.
For now, yes. Differentiation is key.
Okay, so let's look forward. What are the catalysts that could make the market wake up and re-rate this stock over the next, say, 6 to 12 months?
The next few months are critical. The number one event is the Q4 earnings release. We're expecting that around January or February.
And why is that one so important?
It's their chance to prove that the 52% subscription growth wasn't a fluke. If they post another strong quarter, it proves the trend is sustainable. The whole narrative shifts from turnaround story to proven growth leader.
And with that will come the guidance for the next fiscal year.
Which is what the big institutional investors are waiting for. They want to see that this new profitable growth trajectory is the plan for the long haul. Strong guidance could bring a lot of money off the sidelines.
Beyond earnings, what about the bigger picture? The industry trends.
It's all about AI. Enterprise AI integration. RPA platforms like UiPath are becoming really the essential plumbing for AI.
Oh, so?
Think of UiPath as the hands and feet for the AI's brain. The AI decides what to do, but it needs the RPA bots to go into the different systems, get the data, and then execute the action. They're sitting right at the intersection of AI and actual business operations.
That makes them strategically vital.
Yeah.
Which I guess brings up a more speculative angle.
It does. M&A, an acquisition. Given their market leadership, their cash flow, and how important the space is becoming, they would be a very attractive target for a larger software or cloud company.
And of course, the macro factor we can't ignore, interest rates.
Yes, federal rate stability. If the Fed stops hiking or even starts to cut rates, that's generally a huge tailwind for high-growth software stocks. It makes their future earnings more valuable today, which could trigger a big re-rating. So to sort of sum it all up for you, the investment rationale here is pretty clear. You have this combination of incredible 52% subscription growth, those elite 82% gross margins, a solid turn to positive cash flow, and management just buying back stock aggressively. It all points to a real fundamental transformation that I think the market hasn't fully priced in yet.
That is a compelling story. That profitable growth inflation point, especially with those margins, is definitely something for you to watch as we head into those Q4 earnings. Thanks for walking us through that. And for everyone listening, be sure to subscribe so you don't miss our next analysis. We'll see you next time on Smart Wealth with Joshua.